The markets are crashing. Billions wiped out in minutes. Investors panic. The biggest mistake investors make isn't investing at the wrong time. It's panic selling at the wrong time. What if I told you that market crashes don't have to be scary? I recently had a conversation with someone whose opinion I really respect, and they said the worst time to invest is when your barber or hairdresser starts giving you stock tips. Not long after, I sat with a prospective client who told me, Hardy, after the incredible returns we've seen over the last few years, I'm looking to invest more aggressively. I have some money available in my home loan. Should I withdraw it and put it into the market? That got me thinking, can this really continue? Are we in a bubble? By the end of 2024, global markets surged by 20%, yet the global economy lagged at just 3.3% growth. And in South Africa, even slower, only 1.6% GDP growth. Over the past 5 years, global stocks have climbed 80%, while global GDP only expanded by 12%. Something doesn't add up. Can markets really keep outpacing the economy forever? The thing is, history has a funny way of repeating itself. Every major bull market has ended in a correction or a crash, from the dot-com bubble to the 2008 financial crisis. And South Africa isn't immune either. Just look at the massive dip in SA equities during the COVID-19 pandemic. And when that happens, the people who thought this time it's different are the ones who get hit the hardest. Most people lose money in crashes, not because they invested, but because they panicked. In this video, I'm going to break it down. What this means for the way you should be investing your money, how to protect yourself from a potential crash, and how this will impact your retirement planning. If you want to invest wisely, reduce risk, and avoid being caught in the next market meltdown, then this video is for you. Hello everyone, and welcome to the Family Wealth channel. I'm Hardy Swart, a certified financial planning professional and director at Family Wealth Custodians. Before we dive in, we have a dream to help over 1 million South Africans improve their financial outcomes through educational content and videos like this. You can help us by subscribing to our YouTube channel, hitting the notification button, and if there's a video that you actually find informative or helpful, please share it on your social media accounts. Without further ado, let's jump in. Quick disclaimer, this video is for educational purposes only. Make sure you speak to a certified financial planner before making any big financial decisions. Being a financial advisor and wealth manager, especially for retirees, is all about balance. On the one hand, your clients' assets must grow because of the real risk of running out of money, because of the long-term impact of inflation, especially medical inflation, which according to Stats SA rose by more than 12% in 2024. This can significantly erode your purchasing power and make retirement more challenging. Simply put, if your money isn't growing, you're falling behind. But on the other hand, to quote my favorite Spider-Man movie, with great power comes great responsibility. Managing someone's life savings means making careful, rational decisions, not chasing the hottest trends. When Tesla or Nvidia are hitting record highs, or when a South African company like Capitec continues incredible growth, the temptation is there to go all in. But even with great companies, putting all your eggs in one basket is rarely a wise long-term strategy. One of the most common reasons why people want to leave their current financial advisor is because they underperformed the JSE All-Share Index, or my offshore funds didn't beat the S&P 500. That advisor may or may not be a great asset manager, but here's the real question. Is this even the right benchmark for you? Proper financial advice isn't just about outperforming an index. It's about helping you achieve your specific financial goals with the least amount of risk. A good advisor focuses on the following: building a globally diversified portfolio suited to your risk tolerance and financial objectives, ensuring your investments are aligned with your long-term retirement strategy, minimizing unnecessary risk and emotional decision-making, and structuring your finances in the most tax-efficient ways by helping you navigate these life uncertainties with a solid financial plan. At the end of the day, success isn't measured by whether your portfolio beats a particular index in a single year. It's about whether you can retire comfortably, sustain your lifestyle, and protect your wealth through every market cycle. That's what real financial advice is all about. As South African investors, we face unique challenges. Our economy makes up less than 1% of global GDP. This means that many of the world's best investment opportunities simply doesn't exist in South Africa. To access these opportunities and to hedge against the volatility of the rand, we invest a portion of our funds offshore. By the end of 2024, the S&P 500 had skyrocketed nearly 50% in just 2 years, an extraordinary surge that stands out in the market history. The last time we witnessed such a rapid gains was during the late 1990s, when the excitement around internet-based companies fueled the infamous dot-com bubble. Fast forward to today, and technology is once again at the center of the rally. However, this time, it's not a commerce startup or speculative website capturing investors' imaginations, it's artificial intelligence, AI. As valuations continue to climb, the pressing question remains, is this another market bubble in the making? So the important question to ask is, how do I identify a market bubble? The price-to-earnings ratio, or PE ratio, is one of the most widely used tools to determine whether equities are attractively priced or overvalued. It's a simple calculation, the share price divided by the earnings per share. In theory, investors want to buy shares in healthy, growing companies when they are trading at a low PE ratio. This typically signals a good buying opportunity. However, there's a major flaw in this approach. During periods of economic downturn or recessions, such as the COVID-19 crash, share prices drop, but corporate earnings also decline sharply. This temporarily inflates the PE ratio, making it look as if stocks are expensive, when in reality, this may be a good time to buy. This creates false signals, leading investors to mistakenly believe that the market is overpriced when it's actually an opportunity to invest. To address these shortcomings, Nobel Prize-winning economist Robert Shiller of Yale University developed the CAPE ratio, cyclical adjusted price-to-earnings ratio. Unlike the traditional PE ratio, which looks at just 1 year of earnings, the CAPE ratio smooths out short-term fluctuations by averaging the last 10 years' earnings, adjusting for inflation, and then dividing this by the current share price or index price. Think of the CAPE ratio like checking a company's price tag over 10 years instead of just once. It helps avoid misleading signals from short-term economic noise. Historically, a high CAPE ratios have signaled lower future returns. According to an article in Monthly Fool, as of February 1, 2025, the S&P 500 Shiller CAPE ratio stands at 38.05, an elevated level that has only been exceeded during the dot-com bubble of the late 1990s and briefly in 2021. This indicates that US stocks are currently priced higher than almost any time in the past 125 years, aside from those two periods. Put simply, when investors pay a premium for every dollar of earnings as reflected by the high CAPE ratios, the likelihood of strong future returns diminishes. For South African investors with offshore exposure, this serves as an important reminder that valuations matter, and periods of excessive optimism are often followed by more modest returns. Another key concern is the concentration risk in major US indices. The S&P 500 and Nasdaq are heavily weighted towards a few large companies, especially tech companies, the so-called Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. These companies have been the primary drivers of the recent market rally. However, high CAPE ratios indicate that investors are paying a massive premium for these stocks, increasing the risk that a slowdown in earnings growth could trigger a market correction. For South African investors holding ETFs like the S&P 500 or the Nasdaq 100, this means a significant portion of their portfolio is tied in a small group of high-priced stocks. One of the reasons South Africans invest offshore is to hedge against rand depreciation. The US stock market has historically been a reliable way to preserve and grow wealth in hard currency. However, when valuations are high, South Africans investing offshore need to consider whether they are buying US equities at an inflated price. If the market corrects while the rand remains stable or strengthens, investors could face losses not just in dollar terms, but also when converting back to rands. While the US remains a crucial market for offshore investments, current valuations indicate that South African investors should exercise caution. Blindly following past trends, assuming that the US stocks will continue delivering outsized returns, could be a massive mistake. While US stocks are currently trading at historically high valuations, opportunities still exist elsewhere. European stocks, for example, are trading at a much lower CAPE ratio compared to many US stocks, making them an attractive option for a value-seeking investor. According to BlackRock, between 1971 and 2021, when US stocks returns were below 4%, international markets outperformed 100% of the time. And when US stocks returns were below 6%, international markets outperformed 94% of the time. This is a crucial lesson for South African investors. The JSE is a small and highly concentrated market with a heavy reliance on commodities, financial services, and a handful of dominant companies, like Naspers and the large mining houses. While these companies have performed well historically, they do not provide true diversification. To reduce risk and enhance returns, investors should be looking beyond South Africa and even beyond the US to create a globally diversified portfolio. One of the world's most respected investors, Ray Dalio, the billionaire founder of Bridgewater Associates, has called diversification the holy grail of investing. He believes that a well-diversified portfolio should be spread across multiple uncorrelated assets. These are investments that do not move in tandem, either directly or inversely. For example, gold and the S&P 500 are not tightly correlated, meaning that if US stocks decline, gold prices may not necessarily follow the same pattern. Similarly, different geographic regions and industries do not always react to market conditions in the same way. According to Dalio, the key to long-term investment success is diversification across asset classes, industries, and currencies. At Family Wealth Custodians, we believe that diversification isn't just a theory. It's the best defense against financial disaster. A well-diversified portfolio helps reduce risk, smooth out volatility, and improve long-term returns. Here's how we strategically diversify portfolios for South African investors. First, by diversifying by geography. South Africa makes up less than 1% of global GDP, meaning that a JSE-only portfolio is extremely limited. By investing offshore, you gain exposure to things like developed markets such as the US, Europe, and Japan for stability and strong institutions, emerging markets such as India, China, and Brazil for high growth opportunities, and frontier markets such as Vietnam for potential long-term upside. South African investors holding 80% in local stocks are heavily exposed to the rand and South Africa's economy and political instability. By adding, for example, a 50% or 30 or 40% offshore exposure, they hedge against local economic shocks and currency weakness. Secondly, by diversifying by sector. The JSE is highly concentrated in financials, mining, and commodities, leaving gaps in high-growth sectors like technology and healthcare. By going global, investors gain access to technology such as US firms Microsoft, Apple, and Nvidia, healthcare, companies like Johnson & Johnson and Pfizer, or consumer goods, brands like Nestle and Unilever. A basic example is a portfolio overweight in mining stocks. This will suffer when commodity prices drop. But by holding global tech, healthcare, and energy stocks, the investor remains protected. Thirdly, by diversifying by asset class. Investing in only stocks is risky. A well-diversified portfolio includes things as equities and shares, which provide growth potential and long-term capital appreciation, bonds or fixed income, which provide stability, income, and protection during market downturns, and real estate, which provides an inflation hedge and income generation. It also will include things like commodities such as gold, agriculture, which provides a hedge against inflation and geopolitical risks. Furthermore, something like alternative assets, which might include private equity or hedge funds, these are less correlated to the stock market fluctuations. Another example is that during the 2008 financial crisis, global stocks fell over 50%, but bonds, gold, and cash helped offset these losses. The fourth thing is by diversifying by company size. Different sized companies perform differently in various market cycles. One of the great success stories in South Africa is Capitec, that went from a small cap company in the early 2000s to South Africa's biggest bank as measured by the number of clients they have, more than 20 million. For example, a well-diversified portfolio would have a mix of large, mid, and small cap companies. This will help for future growth while managing volatility. And at number 5, diversifying by currency. A A weakening rand is one of the biggest risks for South African investors. Diversifying by holding assets in US dollars, which is the world's reserve currency, or euros, which provides stability and from strong institutions, or pounds, which is a very defensive currency in times of a crisis, or for instance Australian dollars, which have strong ties to global resource demand, provides much more diversification in your portfolio. For example, the rand lost over 40% against the US dollar in the last decade. Holding US dollar denominated assets would have protected purchasing power. At Family Wealth Custodians, we construct a globally diversified, risk-adjusted portfolio using platforms such as Allen Gray 91 and a couple of others. Here, we can manage an entire portfolio on one central platform. A well-diversified investor doesn't just survive market downturns, they thrive through them. And remember, diversification isn't about avoiding risk, it's about managing it wisely. The goal of investing is not just to chase returns, but to manage risk effectively. By diversifying beyond a single market and across multiple asset classes, South African investors can reduce risk and position themselves for more stable, long-term growth. While historical data gives us valuable insight, the future is always uncertain. The key to a successful retirement isn't just about predicting everything perfectly, but rather building a plan that can adapt to life changes. Everything we discuss and analyze with clients is just a snapshot in time. Each year, circumstances change, portfolio values fluctuate, spending patterns vary, and personal goals evolve. Staying connected and regularly updating the retirement plan is essential. Retirement planning is not just a one-time task, but an ongoing process that requires regular adjustments. If you have any questions or need further assistance, feel free to reach out. We're here to help you navigate your retirement journey. If this video gave you something to think about, hit that like button and subscribe for more no-nonsense financial strategies. If you know someone who's worried about the next market crash, share this video with them. It might just save their investments.